pronto, buen trading.
Está con nosotros también Tom Ross, gestor de carteras de deuda corporativa de Janus Henderson. Tom, good morning.
Good morning.
What do you think about Fed decision yesterday?
We thought there was a chance they'd do 100. The Fed, all central banks, they have to be really hawkish at the moment. Inflation is the number one enemy, and that is going to have to be defeated. And with that, obviously they didn't deliver necessarily 100, but it was 75, and it was very hawkish with it. Obviously, we would say probably the most important factor was where the dot plot moved, and effectively what they were trying to do is trying to get the market to price out those cuts that are expected next year, because I don't really think that's where the Fed sort of see this going. So I think they've done a good job of that. Obviously, we saw the front end, sell off quite significantly, but as now the market's really now starting to come around to the idea that growth is slowing, there will be recessions, and therefore longer in duration, 10-year rates, etc. They're actually now coming down in yield, which is what we'd expect into the slow growth environment.
Dot plot and forecast was very strange, because forecast said inflation next year could be around 2.7, 2.8, but this movement in the Fed could be around 4.5. It's very important, this gap between inflation and the position for the Fed. This is normal for investors to understand how is the movement to the Fed in the next meetings?
Absolutely. I mean, look, inflation is the number one thing that everyone has to look for, because inflation will dictate, and all of the central banks have said that is the data point that they will continue to look at. And central banks will continue to have to be hawkish. They will continue to have to hike until they fear not only that inflation is coming down, but that it's coming down enough to a point. There's going to be lots of memories going back to the 70s and 80s, and considering the time when they thought they had inflation under control, but they didn't. This is something that they really need to get down. So we're expecting central banks to remain hawkish for a period of time, and we would say one of our key signals for then really finding a turnaround in spreads would absolutely be when we feel that the central banks have panicked too far in terms of how much they've hiked, but we don't believe that is yet.
And this movement yesterday could change the point of view about government bonds, high yield, and European corporate bonds in this picture?
Look, rates and duration have been an absolute enemy for investors, and we fully understand that investors are facing this really tough environment with obviously negative returns from equity markets, but then also duration and rates and credit markets and bonds that are supposed to be protecting you obviously are not at the moment, and delivering significantly negative total returns. The only good thing from this is that we're starting to get to levels where that is going to be a case where actually duration and bonds are going to start to be your friend and actually start to provide some level of correlation. Now, whilst the front end of the US Treasury curve sold off, obviously what we saw was a duration and 10-year bonds actually rally a little bit on that expectation of lower growth, which is exactly what bonds are supposed to be doing and haven't done for a long time. So hopefully we're getting back into more of a normal cycle where those correlations are starting to establish themselves again.
How could resist the high yield in this environmental?
So high yield market sold off, I think, as we were expecting as well. Anything sort of more hawkish there. The market is not yet, we believe, pricing in some of the sort of probabilities and expectations for recessions globally. Recession is pretty much nailed on in Europe and in the UK, we believe, but we also think it's highly likely in the US as well. And obviously the US is such an important market. We think about markets very much globally as well. And this was just another step towards that sort of more hawkish view, that idea that growth is slowing, and that's clearly negative for high yield. But I would say the good thing from this is we're starting to get closer to the point where spreads are actually pricing in those risks, and at that point, clearly credit is going to be a better investment class for investors to be in.
What is the worst word in this moment? Stagflation or recession?
Yes, I mean anything with inflation. So it's the stagflation argument, because in all of the other cycles we've had previously, what's turned the cycle, what's helped markets back out of it, it's been the support from central banks and it's been monetary stimulus. with inflation there, the central banks can't do that, and they are still fighting inflation first. In fact, a recession, the central banks have pretty much told us that's what they want. They need slower growth in order to get inflation down. They need higher unemployment to get wage inflation down. And until that inflation is dealt with, then the ability to get monetary stimulus is going to be unlikely through to helping out risky asset markets.
What's the next step for central banks? Today we have the Bank of England, European Central Bank need to react to the Federal Reserve. What's the next step in this moment?
It's going to be a continuation of the same. In fact, it was probably the Bank of England and the ECB that were the first ones to say, look, we will hike, we will get growth down. And in fact, it was only the Jackson Hole speech that the Fed, we believe they thought it before, but the Fed really opened the hand and said, yes, we're going to have to destroy some growth here in order to get inflation down. So we think it's more of the same. I guess the interesting factor is going to be what happens with fiscal stimulus. Because already in Europe, trying to fight the cost of living crisis, trying to fight the higher energy prices, obviously that fiscal stimulus is helping out inflation prints in the short term, but they're still going to be pushing up inflation in the longer term. And that fiscal stimulus is going against what the central banks are trying to do, so they're probably going to potentially have to do even more to offset that fiscal stimulus that's there.
It's the end of the whatever it takes of European Central Bank?
Until they feel that inflation is under control, and they are sure that inflation is under control, then yes, at that stage. But there are still many longer-term structural reasons why, going forward, advancement of technology, etc., that we will see an environment of very low inflation again, and maybe we get back to that. But again, we don't think that's anytime soon.
You have some problems, the last question, about Italy or Spain in this moment?
Spain actually has...
For fragmentation system.
Yes, so Spain's in a better position in terms of its energy supply. Italy is in a tougher situation there, and in terms of its fiscal gap that it can use and its fiscal headroom in order to fight this higher inflation is tougher there. And obviously with elections coming up in Italy later on this year, it's going to be a tough spot. So we've tended to stay a little bit further away from some Italian companies within high yield and focus a little bit more on other parts of Europe. But again, we tend to look very globally. So, throughout the rest of this year, we've been overweight the US with a better growth outlook there, and that continues to be the case. But actually, European high yield is now really starting to price in some of those risks, and is probably closer to that stage where investors can more confidently invest in high yield, because a lot of the potential defaults that might come through, a lot of the negativity is already priced in, and as we say, with rates and duration also then becoming a little bit more of a friend for investors as well, then that could be a great opportunity to invest in high yield in the future, in areas like Europe.
Tom Ross, Janus Henderson, thank you very much for this time, for having this time with us in this morning. It is very complicated and red morning in equities. Thank you very much.
Excellent. Thank you very much indeed.